planning practice in Alexandria, Virginia. Most of our clients are what we call soft market cities. That's not the entirety of our client base. We have mountain resort communities and strong market cities such as Seattle or Austin, for instance. But most of our clients are on the other end of the spectrum, where the essential defining characteristic is that supply exceeds demand and prices are wobbly. That's a sweeping statement for any market, because there's always going to be a segment of the market that's performing very well due to its location or the configuration or the price point or what have you. But in general, our clients are cities like Danville, where at some former point in time, the housing market was really dialed in, absolutely precisely aligned with the nature of the economy, the wage structure in a city, the demographics, and that's not the case in Danville today. It's not the case in so many cities today. I know all of you in the mortgage lending field and for the realtors and for the agents and brokers are acutely aware of that. So yes, it's sobering information, but I don't suspect for any of you it would qualify as surprising information. So that's the first point I'd make. The second point is, so I'm still learning how to use reading glasses, so there are no quick fixes. I'm sure you've heard that as well. This is a 40-year trajectory that you're on the back end of, and that doesn't mean a 40-year dig out, but it is a dig out that's slow. So I think that's a second point. And I think the third point is that so often in soft markets, Rochester or Buffalo, for instance, in Erie, Pittsburgh, depending on different moments in their life cycle, the public can get a hold of the idea that this is a problem for the city to fix. Right? And I like to put a sort of a nail in that coffin, sort of stab that a little bit this morning. It's a challenge that requires contributions from across the board. So partnership's really going to be at the essence of any forward progress on firming up the floor in your housing market and then getting supply and demand into better alignment. And at the center of that, and I believe this deeply after 25 years of this, is that realtors and mortgage lenders are at the absolute centerpiece of this. Absolute centerpiece of this, because you're the front edge of marketing product. You're at the front edge of knowing what sells, what doesn't sell, what's in the way of sales, where risk is, how to think about risk, product identification, and customers. So all of that is absolutely at the epicenter of, I think, any progress in getting this market to where you want it to be. A couple of quick things. We got here last May, June, July, thereabouts. Our clients in the city manager's office, Joe King and Ken Larking, and in Housing Community Development, Earl Reynolds, have been great clients. And Hampton, thank you, and the realtors that we were able to talk to in the process and learn from, been very informative for us. So we were able to actually collect a lot of information and learn quite a bit about the city. I'll go through slides. You can stop me at any point in time. That slide is fuzzy, blurry, nonsensical. I don't like it, whatever, that's fine. We can talk about that or do Q&A at the end, so whatever works. Let's see. So, scope. I took two of my staff members. We dropped them here in the summer, put them in a non-air-conditioned dormitory in Averett for 6 weeks. They were kind of not happy with me, but they came down here and they put, two of them put an eye on each of 20,000 structures, residential structures, and we scored on a scale of 1 to 6 every structure in your city. Paused, took a look at it, walked around the back, looked at the gutters, the downspouts, the roof sagging, the trees coming out of the gutters, whatever it was. We looked at your product. We tried to understand your market. So we scored on a 6-point scale, and I'll walk you through that. That's sort of one chunk of data. The second chunk of data is we go through sales records, which in our view is the gold standard for understanding a market. A lot of people really, yes, census data is valuable, but nothing is as valuable as MLS data. Nothing. When you take MLS data and you marry it to what physical structures look like on the street, now you can really tell a very, very interesting story. And then when you attach that to lending data, particularly HMDA data, you can really begin to get a sense of where money is flowing. And then if you then cross-check that against borrowing, whether that's for first or second notes, for construction lending, and then your permit activity, you get a sense of the market. So that's what we do. We did a lot of multivariate regressions. It allows us to compare a two-bedroom structure built in 1930 to a three-bedroom structure built in 1940. It allows us to really do some innovative things, and we can talk about that a little bit. Our interviews helped us out. I can't say enough about the technical expertise at the city level. It's just superb. So Joe's assembled a great staff, and that helped us out. And then we did a lot of leakage analysis. We really looked at your retail. So I'll run through that. A couple of the quick high level. Are you very similar to so many company towns across the country, where the employment base is radically changed? Yes, but unlike so many cities that we work with in Ohio and Michigan, for instance, you've navigated, and I think this is a credit to the city council and to the city manager's office, to the administration in particular. You've navigated that pretty well. So I wouldn't call it a soft landing so much as the beginnings of a smart landing. Downtown River District Demolition Safe and Sound program. Our sense is you've bottomed out, hit bottom. I mean, and you're up. Okay, so it's a long slide, and what most cities don't know how to do is firm that up. So it just keeps sitting there. So now you've done some really smart things to turn that around, and now the trick is what's next. And in our sense, you've done this on your market. The floor is now pretty firm. There will be a natural bias to take your foot off the gas pedal from a policy level, from a philanthropic level, from corporate contributions, to maybe take your foot off the gas pedal a little bit, think we're okay. The demographic trends are actually beginning to, in the region, work in your favor a little bit. I think that would be a mistake. I don't think you will get to the next level if you take your foot off the gas pedal as a community. So first finding, this is a very affordable market. Everybody knows, this is your lenders and realtors, so your front-end ratios, back-end ratios, the affordability ratios, however you think about it in this market, you have to, so finding number one, this is more for city council than for you, but this is an incredibly affordable market. The question arose last night in city council, yes, but don't we have a lot of folks who are really struggling to either make repairs or make upgrades or even buy a home? That's true, but that is not the problem to solve in Danville. The problem to solve in Danville is to rebuild the middle class. And so what you do not have is an affordability problem. What you have is an excess supply problem. So that's, and if this group isn't championing that and making that point, driving that point home repeatedly with city council, then policies may or may not be bent appropriately. So that's a very key finding. The real issue here is a mismatch, your supply and demand, but also your expectations, the composition and value of the stocks you've got, as you know, what the market is hungry for. Sometimes the product isn't there, and you're just missing product in so many instances. Even if you build the product, though, I think you have an amenity issue, and we'll talk about that. And then these become limiting factors. This mismatch becomes a limiting factor, and then it becomes an economic development issue. So these are the 7 points that we drove home for the city council last night. Geographic isolation, population loss, decline in wages, excess inventory, a real withdrawal of reinvestment dollars at a homeowner level and at a property owner level, limited product and missing amenities. I would assume that's not a surprise to anybody. Is that fair? That's how we think of it in any case. How does that translate? What that means is, if you notice on the slide in the circle there, you are a long distance away from any place that is growing in population. And what that means is that your isolation means you can't cannibalize. You have an affordability advantage, but you can't turn that into an advantage because you can't seize excess demand from an adjoining market. There is no adjoining market. So it's all within. Right? So what we're really looking at here is sustained population loss in that context of isolation. So when we look at your commercial capacity, your market capacity to support neighborhood serving retail, for instance, we're multiplying rooftops times income, so we have fewer rooftops. But we also have in point 3 a decline in wages. So it's X times Y. Both X and Y are lower. We then have an excess inventory issue, which means we've got a lot of empty space. Not only do we, and underutilized space. So we've got stocks that in another market would be occupied, whether that's commercial or residential, and so they sit fallow. And they extract value from that immediate location. In turn, that really undermines confidence, as you know, and so the primary, we see 2 primary examples of lack of reinvestment in the Danville market. One is just generally deferred maintenance. Okay? It doesn't really pay off for folks, particularly for absentee owners. The value of land and then the prospect of negative equity just doesn't make sense given the cash flow that an absentee owner can get. So that's one reason you're seeing such a rapid turnover of single-family stock to absentee ownership. So you've got somebody who's 71 years old, they're in a brick ranch, they want to sell it for 105, you've got to sell it for 79. They don't find a buyer. You finally do get a buyer in there, and the buyer is an absentee owner. Right? Or if there isn't an absentee owner, it's their son-in-law who's living elsewhere and they're going to rent it out. And so now the value on that block continues to migrate south. So whoever is holding the first note on that is a little sketchy. There's just no incentive to do either of the 2 things that are needed, and this has been the case for a long time. One is maintenance on the product, although that's less the case on your brick ranches post-1965 than it is on your pre-1930 wood frame structures. And what's more the case is no capital improvements. So a lot of the stuff that went in between 65 and 85 is still sitting on its first roof, still sitting on some sort of an avocado green, lime green kitchen, It's stuff that, so any credible buyer is going to discount for having to cure all of those things, just driving all your prices further and further south. So is that right? I mean, more or less? No? Okay. Okay. So then you end up with limited product and I'll come back to amenities in a second. Can I see a show of hands? Less for me than, because I can see everybody's face, than for everybody there in the all of you. Folks between 28 and 45 years old. Can I raise them high? Can everybody look around? Okay. If you don't build a product for those folks, your city is going to die. Okay? If your housing products don't meet their requirements, there's no reason for the mortgage industry to take risks in this market. And there just isn't going to be money to be made. That's the bottom line. That should come as no surprise, sobering as it is. All right? So you need a product for them. You need a starter product, you need a pickup product, you need a product and so that's the name of the game. So what you've got here is value down, buying power down, confidence levels down, reinvestment down, values down. The trick here is to flip this, and at the end of the day, that means starting at the bottom right, you've got to diversify your population. What you've seen in the last 40 years is a massive demographic shift that makes you bottom heavy. Right? So you've got too many households struggling too much at the bottom third of the economic ladder, right, who aren't fully participating in the economy, aren't capable in the short run of participating fully in the economy, with important and profound impacts on housing values, housing stock, settlement patterns, and then ultimately, the neighborhood quality and the retail. So the name of the game is to rebuild the middle. That will drive retail. It will begin to push value up, and then you'll get the fiscal strength without which You can't, as a city, provide the infrastructure and maintain your road system at the level necessary to compete. Okay? So 4 consequences. 1, large numbers of what we call nearly valueless pre-1930s wood-framed houses throughout the city. Okay? So this is a tricky issue with respect to historic preservation, so I just want to be very clear that I am not on record as recommending the demolition of important architectural, historically significant structures in the city of Danville. Right? What I am saying is that you've got about 5,000 valueless wood-framed, non-significant, non-important structures in the city of Danville, and they do need to come down. Okay? So I want to draw a big distinction between the high potential value, architecturally significant structures typified by what you have in the West End, right? Old West End, versus pre-1930s wood frame structures, 600 square feet to 1,100 square feet, usually built on 6 to 15% grades that never should have been built in the first place. They got to come down, okay? That's the first one. Second is, you have 8,500 of these things in the city, right? So I don't know, I wish to cast no aspersions in the rearview mirror, okay, on the home builders, all right, who pushed this, who built and your brethren who pushed this product for 25 years, but this is a near valueless product now, okay? And you're not alone. Every city in the country is coping with this, okay? And so the trick here is, how do you make it a valuable product? And so where I would encourage all of you to be using all of your skills now is to be thinking, what is needed? You know what's needed. Every Tuesday, you take somebody through these homes, and they look at them and they think, well, God, it's a 7-foot 4-inch ceiling. That's not working, right? Or gosh, it's an old kitchen. That's not working. Or it hasn't, never mind the lack of maintenance on they're unappealing, right? Nobody knows more than realtors what has to happen to this structure to make it appealing. You are the policy vanguard for the city. So for the city to be thinking about what is our role from a public policy level in turning that into a product that's marketable, they need to hear from you. Is it a second bath? Is it new kitchen cabinets? Is it rewiring? What is it? Okay? The name of the game is to get the land underneath it worth something. And in order to do that, demand has to go up. And in order to do that, we've got to reduce the inventory of land in the city, reduce the inventory of valueless structures in the city. We've got to begin really rethinking at a planning level how to collapse folks into the right locations. All right. So let me sidestep the housing market just for an instance. It's always tricky to be candid with a community because you can hurt feelings, and I don't want to do that because I don't like my feelings being hurt. But let me illustrate my point. This building we're sitting in here, would everybody agree this is a fabulous facility? World class. It's in the wrong location. It's in the wrong location. Where should it be? Where, specifically?
Well, I said front and center, but that's not specific.
No, that's right, front and center. It's the right facility in the wrong location. Because this market isn't big enough to stretch. All right? Imagine if this facility and all the intellectual imagine if all of you walked here, right, from having parked your car someplace between the hospital and Main Street, and this facility were there. How would downtown function? The name of the game in Danville is to get right-sized. So when we look at your leakage as a city, your commercial leakage as a city, as a whole city, it's actually not that huge because it doesn't have, you have to drive along. You are leaking significant grocery dollars, for instance, to Greensboro. But that's not really the epicenter of it. Your retail market is really smart. Your commercial market is really smart. It's in balance with demand within the city. Okay? but it's in the wrong look. Often it's stuff is so spread out in the city that you don't get compaction and the benefits of compaction and the multiplier effect. So this sidestep off the housing market here, really stepping into comprehensive planning for a second, it's the same story. What is where with what effect? Okay? So the name of the game is underlying land values, and the way to get there is through compaction and density in all things. Okay? Even if we address this, you don't have neighborhood serving retail. So we might be able to put residential structures, your market might be responsive and put residential structures at a higher price point near the hospital, but if there isn't neighborhood serving retail, we have a limiting factor in moving that product. Okay? The folks who raised their hands earlier, they would like to walk someplace and actually have a cup of coffee at 4 in the afternoon. Right? You've got multifamily sites throughout the city that are problematic. Okay? They do not need to be rehabilitated. All right? They need to come down. They are radically affecting nearby property values. Okay? And the underlying story there is that as long as fallow structures, whether they're single family or multifamily, absentee, a landlord, of a toxic owner quality, as long as those are out there, you're making the market is making the city manager's job harder in terms of revenue. So impacts. This is ultimately what the market looks like. I don't know. Can you see? Does the map look good from up there? So you can see the red areas. All right. So what we do is we score on a 6-point system. What you're looking at here are averages. So then we do every single parcel, but then we average each block. And then so what you're looking at here is geocoded representation of the city. And you should, in a healthy market, see 75% of this as green, light green at least. Okay, so we've got really about 30% that's in that situation. So we've got some work to do. And where this work is, when we have clustered challenges, we've got, as you can see, no small number of them. Some real soft market issues. All right, this is where property conditions are real trouble. We've got extensive deferred maintenance. We've got negative equity. We've got blocks in real trouble. Okay. What we also have, though, is we don't have the capacity in the general revenue to resolve all of those. So what we've got to do is figure out where to do that. And in our view, this is where you want to focus. Okay. So this doesn't mean that we wouldn't focus. There aren't challenges elsewhere. It's just where's the best bang for your buck. So that's where we would focus. And more specifically, if we drill down, what we would do is we would draw your attention to the River District and the 3 major assets on the south end, the community college, the hospital, the regional medical center, and Averett, and then that towards the River District and the river. So I hope the map is fairly clear. And we would want to encourage the city by way of policy to think a little bit differently in each of the sub areas. So as you can see, we would there are certain strategies that we would want the city to think about depending on geography. The principal place we would suggest the focus is right here. So this is the sweet spot. This is the space between the train station, the hospital, and Main Street, the fountain. In that space is a real potential competitive advantage. You want a high-end product, a medium high-end product. You want a rental product. You want the product to have to be mixed income. So you want it at 100% of AMI, 120% of AMI, 150% of AMI, and to the extent that the regional medical center becomes a partner at 80% of AMI, so that you've got a very competitive rental product within walking distance of the medical center. So you have 1,500 employees there. You have 300 employees in another 151 hospital-related businesses, all within a half mile radius of the hospital. That's a huge retail market, and it is a enormous opportunity for a residential product right in there. That is a adaptive reuse of the existing structures there, but there are a lot of underutilized lots where an infill, a dense infill product at 30 units an acre will market very well here. So we would definitely want to be looking there. Up on along North Main, you've got really sketchy 1960s post-war ranch houses that are going to be hard to market and just get harder and harder and harder in that section. So that's an area where we got to be thinking creatively about acquiring and holding some of those structures, possibly constructing a development entity that's got some patient capital and a time frame that works for them. But that's an area that we might want to be thinking about holding some structures. And then down at the bottom left, really on the Montague corridor between the community college and Averett, you've got, I think, as we get closer to the mill site, there's what my staff called the finger streets. They didn't know how else to describe them. It's just the Dallas and Baltimore, the long streets there. The structures in there are tricky, but you've got a really good opportunity there, less to demolish than I think to do some good community organizing, some good rehab lending, upgrade those structures when it makes some sense at a very surgically precise level. And I think that's an area that might have some future value, particularly as we move south and west, and deserves further discussion. In here is an important target area. We would call that, we think it's something of an economic dead zone. It's all your potential is there, and almost none of it is realized. So you've got 12 to 17,000 cars a day coming in there. They're coming for chemotherapy. They're coming to talk to their radiologist, what have you, get their teeth fixed. I don't know what they're doing, but that's huge volume of folks, right? And you want to make sure that their trip in is beautiful, and so that suggests city planning policy. And you want to make sure that on arrival they're not in the hospital cafeteria, right? That they're leaving the hospital. So you have a new CEO coming into the regional medical center. So the first conversation I'd be having is, don't put a lot of money into upgrading the cafeteria, right? And from an economic development point of view, it's what role can the city play around that in spurring residential real estate development and in retail development around there. So then when we look at your market values, you can see on the sale price here, so this is 50,000, 50 to 100, 100 to 150, 150 to 250, 250 or more. We're taking a look at where your market is in various locations, and that brick ranch product on the top left, those two areas there become really important for the city in the long run. It's a huge concentration of your 8,000 plus, nearly 9,000 post-war brick ranch homes that need to be upgraded. And so that's not a ticking time bomb. I mean, it's not ready to go now, but that's a problem we have to slowly chip away at. And so I'll come back to it, but I think we've got to be looking at a target number of close to 1,500 of it. We as a city, we as a community have to somehow upgrade about 1,500 of those in order to really take your market to the next level. So 1,500 over 10 years is 150 brick ranch, post-war ranch houses that somehow have got to get, repositioned in the market. It's 150 transactions a year. So that's where I would recommend your energy be. So what to consider? Downtown infill. We think your downtown area can absorb about 200 medium to high-end rental units. I don't generally I'm not very comfortable with absorption rate, projections in markets that are, just starting to get solid footing. This is not a bankable market analysis from that point of view. But I would suggest that, the number around 200 units is probably a good number, all right? And so some analogs. I don't know how many of you have been near Coors Field and know the lower downtown area, Lodo in Denver, it's a market very similar. So Denver's going great right now, but Denver it's oil and gas, peak and valley. Silver market's up, silver market's down. Denver is only today truly diversified and a stable market. 20 years ago, Denver was in real trouble. Lower downtown was in real trouble. And so what you see there is an infill product in the top right. You know Shockoe Bottom in Richmond. I'm sure many of you have been there. It's finally turned the corner. The relationship of VCU to the city's aggressive policies on a number of fronts, marrying historic preservation with incentives for infill redevelopment and for adaptive reuse have paid off. Pittsburgh is a good analog. I would argue, actually, Pittsburgh is your best analog for this city, though it is 10 times your size. Pittsburgh is no city was on its knees in American history. Forget Detroit. No city was on its knees like Pittsburgh. No city was rocked with sudden hemorrhaging of jobs and then all the secondary and tertiary multipliers on jobs the way Pittsburgh was rocked from 1975 to 1985. Okay? And at the epicenter of that city coming back from a housing perspective was really focusing and targeting their efforts in a few locations. And so they've got a lot to show for it, particularly around the University of Pittsburgh Medical Center, around Carnegie Mellon, and on the periphery of downtown in some neighborhoods like Lawrenceville. So that's a very good analog as you're looking for an urban, sophisticated product that I think will work very well in this city. Durham, I would go to Durham, and I'm sure many of you have been to Brightleaf. Is that true? I know you know Durham. So, 20, 30, I don't know how many, 30, about 30 years ago, I was a student in Chapel Hill. And, God, it's a long time. And Durham was not what Durham is today. You know, I mean, we in Chapel Hill could really poke fun at Duke because Durham kind of sucked. And today that's not so. It's a good, strong market. And the adaptive reuse of the warehouses there has been very creative. Use of historic and new market tax credits has been extremely creative. Brightleaf is the epicenter. It all started with Brightleaf. So if you don't know Brightleaf, I would suggest that you visit Brightleaf and look at the retail and look at the housing there. It's a fabulous indication of what you can do here. And where it ought to go, where products like that ought to go, are right downtown, where this building ought to be. So here in Pittsburgh is Market Square. So this is so the parking lot, I hope the owner is not here in the room, but across the street from Golden Leaf, is it Golden Leaf? Somebody should explain to me why that is a parking lot. Please. No, I'm asking. Why is that a parking lot?
It was a fact of least resistance.
It should not be a parking lot. That's what should be right across the street from Golden Leaf. Your market can support that. You have, I'll come to this later, there's $34 million in leaked retail from the area around the hospital. $34 million a year. You're sending it to the mall, to the Starbucks out there, but it could be captured right in downtown in the River District, right? Ground floor retail with two-story apartments above, right across from Golden Leaf, is a slam dunk. So there's parking issues, there's traffic issues, there's infrastructure issues, but from a market point of view, this is the deal to do, right? And they're all over there, right? So there's true untapped potential there. This is 16th Street in Brooklyn. This is a good example of shoeing in what you could do, for instance, on some blocks on Lynn Street. Okay, it's medium density. It'll market. It'll sell. It'll rent. I know it'll rent, right? But you've got to have retail there to complement it. Right? Second point, we think in addition to 200 units in and around downtown, you've got to take this stuff out of the city. It's got to go. The politics are going to be brutal, but it's got to go. And you can't build back on the land. Everybody should look at that slide. I didn't have time to run it through Photoshop. Everybody should look at that slide, and what you should see is trees. So everywhere you have that in the city, 20 years from now, you should have trees. You need to start dialing down this stock. It's generally speaking on terrible topography The construction was terrible to begin with. There are no buyers for it. There's never going to be a buyer for this product. Okay? So this is a big piece of right-sizing this city. Closer to Schoolfield, you've got a real opportunity. I think you've got really good strength both in right around the college, the Averett, and then further south toward the community college and some of the older African-American blocks. You've got a really good, stable set of blocks in there where you could do proven community organizing and marry that to home ownership development and lending to upgrade some of those structures in there. And so I think that's a real opportunity to stabilize those structures for you lenders in town. That's an opportunity to get CRA credits. It's a place where I think it's a good opportunity to grab onto a market and begin filling in missing pieces on your housing ladder. You've got some significant code enforcement of multifamily structures. So as I suggested in an earlier slide, these are structures that do not need to get rehabbed. Okay? They have to come out. All right. So there's, again, the politics are brutal, but they're holding your market back. So the name of the game is rebuilding your middle class. You could do all of this. You could take this out. You could do a lot of good rehab lending, acquisition, rehab, and sale work closer to Schoolfield. You could, thin and edit obsolete structures. We could, begin driving the land values up, and we could begin infilling downtown. If we aren't doing the amenities, however, I think that you don't have, you're holding back your housing market. So that's absolutely critical, and I've said that a couple of times. I'll come back to it, and then actually let me elaborate on it. So 1,800 employees within a half mile of the hospital, as I said earlier, is not chump change. That's a lot of money that could be captured down there. Finally, on this point here, you could do all of those, but the product on the left, it's a bit grandiose, but just suspend disbelief and run with me for a second. The product on the left not only can be the product on the right. The product on the right is 100 feet, 100 yards from the product on the left. So I live in Alexandria, right? This time last year, the house on the left was the house on the right, okay? So what you should be seeing there, right, is what happens to a structure you can't market when land values make it make the upside so valuable. So how many of you are familiar with the 203K? It's the name of the game here. Is somehow we've got to figure out how do we get a viable 203K product in here, not to turn the left to the right, but to turn the left into something marketable for this community. That's a great product. All right, and generally I don't like any federal products. Right, it's just not my nature. But the essence of it, the core design of the 203K is what I would be encouraging you to begin thinking about from a product definition and point of view. I should probably, that's probably a good time to pause. I think you've got the demographic curve is on your side. The city has done some remarkable work beginning to build a firm floor. The philanthropic community has been superb. To get to the next level, there's going to have to be new infill product in and around downtown, in and around the hospital. It will have to get complemented by significant growth in neighborhood serving, neighborhood scale retail, including grocery, between the hospital and the fountain. I think a significant number, at least 500 of the older pre-1930 structures are going to have to come out. Ultimately, perhaps north of 2,000 of them are going to have to come out. And we're going to have to be aiming for 1,500 to 2,000 of the brick ranches to get upgraded, which means that your real creative contribution to the city is to figure out on those 1,500 structures over 10 years, let's say 150 a year, what's the mortgage product, what's the construction, how do we marry an acquisition loan and then a construction loan and blend it all together so that a buyer might, find a product that makes sense at their price point, and then what would we probably have to lose on each deal? Is there a $10,000 gap on each one? Is it a $20,000 gap? And then, you know, what role does the corporate sector and the philanthropic sector play in that? You know, how can we sort of organize that? So those are the numbers I'd be thinking about.
Well, joining me now is Charles Buki here, and has been working with the city since last May on this comprehensive housing study. And you just heard the presentation from Charles. And before we get started here, Charles, I just want to thank you for your time and effort that went into that housing study, of giving us some great takeaways that this community really latch onto and make a difference. And I want to touch on a few of those with you today, and talking about this soft market that you talked about at the beginning of the presentation. Can you just touch on that, what you mean by soft market? And I know that high housing stock that we have when it comes to supply and demand.
Sure. Markets are, we characterize markets as strong. You know, they can be transitional in the middle, and they can be weak all the way to distressed. And this is what we would call a soft market. And when we label a market a soft market, the underlying idea is that there's more supply than there is demand. Mm-hmm. And so Danville's lost population for many consecutive years, and the housing that was built for a larger population is still here. And so when you've got excess supply, it means your prices are unstable and can be soft, and it can be self-fulfilling. So you've got a soft market where you've got fewer households looking for housing than there are structures. Mm-hmm. So the pricing is unstable, and so you've got in front of you the work of clawing back to get supply and demand into better balance.
And you gave some great examples of the things that your firm recommends that the city needs to be done to do just that. Can you touch on a couple of those, and also the particular area that you mentioned in the around the hospital, sure, Averett, Danville Community College area?
Well, I think that there's no silver bullet. Mm-hmm. You lost a lot of jobs, and many of the jobs that you've retained pay less than they used to, mm-hmm, all things being equal. So there's no single strategy that's going to get everything back in balance. You want to do a number of things, probably concurrently. Mm-hmm. One of those is to recognize that you've got a lot of older pre-1930s wood-framed housing that is in a condition that makes it very hard to have any value on the market. And probably close to 2,000 of those throughout the city are well beyond their useful life. They're now obsolete, and you need to be putting together a very coherent set of steps to at least remove another 500 of those, if not more, over the next few years. Mm-hmm. That's sort of path one. I think in parallel path, you've got to be looking at a lot of the housing that was built after World War II, principally in the 1960s. You have a lot of 3-bedroom, 1-bath, brick ranch-style homes that still have their original roofs, still have their original kitchens and baths, their original wiring, their original HVAC, and those are very hard to market. Younger families look for 2 baths, they're looking for a little bit more room, and they don't have the means to necessarily put in all of those upgrades. And so when sellers are looking for buyers in the Danville market, particularly sellers of these ranch homes, they're not finding buyers and won't find good buyers until the seller puts those upgrades in. So you've got some softness there that has to get addressed. I think in addition, you have a tremendous development opportunity in and around Five Forks and Main Street and the River District, particularly in the radius, the half-mile to 3/4 mile radius of the hospital. Mm-hmm. The Regional Medical Center has 1,500 employees. The medical community and its businesses around the hospital have another 300 employees. Those 1,800 employees represent over $30 million a year in disposable retail income spending. Mm-hmm. And that disposable retail spending isn't being captured in the near downtown area. And so the opportunity to add housing product and retail, grocery stores, coffee shops, at a neighborhood scale in and around downtown, in and around the River District and the hospital is a pretty important third thrust. And if you do those 3 things, I think you're in a super position as a city. And again, one of the consequences will be, for instance, the Old West End will come back proportionate to those investments.
And you talked about strategy one there being the elimination of about 500 homes in that vicinity. And I know the city council, city administration have stepped up to the plate just in the last couple of years, investing about $2 million in the demolition of some of those homes. So I think they realize that step one needs to be done, needs to be completed. I know you gave this presentation to Danville City Council last night. Can you share some of the feedback you received from council members when it comes to that three-prong approach that you just mentioned?
Well, I thought council was thoughtful. The questions were informed. It's clear to me that members of council have shown courage, political courage, by appropriating funds for, or by designating funds for demolition. So that shows a lot of courage, a lot of wisdom. The questions last night, questions about capacity, questions about potential strategies such as land banking, whether or not that's a perfect fit for Danville and the regulatory environment in the state of Virginia is something that would have to get worked through. But the council was asking questions that only come from a position of courage and wisdom. I was impressed with the quality of the questions.
Today, here at the Institute, you met with the Realtors Association, and I was very excited to hear from them when they addressed you that they were willing to do whatever it took to get involved. They were asking you, what do they need to do from their side of the table to make this work?
Well, there were lenders and realtors, there were agents and brokers. There was a small handful of a few developers. Like the city council, I was impressed with the caliber of the people and the quality of the questions. There were some questions from mortgage lenders, from credit union loan officers, that just showed a real grasp of market risk, of the strategic need for the right loan product, both at the construction side and the acquisition side. So it just showed a real grasp of the issues. There were agents who asked really smart questions about the marketability of certain products. They know their market, they know their appraisals, they know their buyers and sellers. There aren't too many markets that we've had an opportunity to work in recently that have such good questions coming from council and from the lending and realtor community. I feel pretty good about it.
And I want to mention that you're in 40 states. You've got a lot of clients you've worked with. You've dealt with a lot of communities. You gave examples of Durham, North Carolina, Pittsburgh, Pennsylvania. Give me your thoughts to our viewers here in the city of Danville of where we're headed and the future here in our city with this plan that you've laid out.
Well, it's tricky. I guess the response is it goes into a contingent category, which is if the city does certain things, and by the city I don't mean City Hall, I mean the community. Right. You know, one thing is you've got to seize upon the tremendous economic power of the medical center, and that means tapping into demand for housing by hospital employees and demand for retail services by those employees should they decide to live in the city. So that's a big contingency that has to occur. If that occurs, and if development, adaptive reuse of some of the finest turn-of-the-century warehouses I've ever seen, that probably the finest collection outside of some of the mill areas in Connecticut on the eastern seaboard, it's prime redevelopment real estate. So there's not going to be a quick turnaround, but if the community can really grasp that significant high-quality creative investments in downtown have occurred, in the warehouse district have occurred, in the river district as a whole have occurred, and that they are followed up on by the creative incentives from the city, by creative marketing by the city and by the real estate development community, and by a robust participation by institutions, then I think you're in a real position to leverage what you've got.
Well, Charles, I really appreciate you taking the time to join us today, and also thank you for all the hard work
Oh, no,
you
it's
and
great
your
to be here.
firm
Thank you.
have done over the last 8 months or so here in our community. And I want to let our viewers know that you can log on to the city's website, danvilleva.gov, to see a copy of the presentation that Charles just gave, and we'll also have that on YouTube as well. If you'd like to log on to the city's YouTube page, you'll be able to see that presentation in its entirety. So, Charles, thank you again for all the great work and for laying out a roadmap for our future when it comes to the housing stock here in our community.
Thank you very much.